One of these
Well,
days, I'll grow up and get some actual podcast equipment and a better background than my Bucky's blanket over the mini blinds, and you know, it'll it'll be presented a little better to be more fair to my guests. But anyway, until then,
do you? Yeah, no. So you're enjoying the podcast. That's cool.
I love it, man. And I mean, do I have time to be doing this when I should be focused more on the money? Uh, I just have to ask myself, well, I have to have an avenue for expression. I have to have an outlet. And this
Yeah,
only takes a couple hours a week. And it's just a passion. It's not like I'm making money on this deal or anything, but uh, I just love it. And I love supporting the network. And it's kind of my paying it forward approach to like-minded people. And one of these days, the wake that I'm making in this body of water is going to kind of pull me forward as well. So,
yeah, absolutely. We have to believe that.
welcome to Blue Sky. My name is Richard Tannery, and I started this program to celebrate innovators, entrepreneurs, and thought leaders.
I find myself this morning, in a mode that is entrepreneurial, and what I mean by that is that, you know, if you're one that's always trying to work deals, find deals, put people together, find a way to create a business and build a business or whatever, you should always be learning, and you certainly should always be pushing yourself in ways that you're like, oh, okay, I just had a conversation that I've never had before, or I've just worked a deal in a way that is somewhat unique to the things I've done in the past, and I'm not a big fan of being closed off. I think you use experiences to shape the way that you do future deals for sure, but you don't close yourself off to new things and new opportunities. And, so I find myself in that space this morning going, okay, there's so much that I don't know. There's so many places that I haven't been. And, as it relates to small business and finding a business and helping someone buy a business and learning from my mistakes and my successes, I feel really good about that space. But then you get into the, 20, 30, 50, $100 million, billion-dollar deals. And then I go, well, okay, these are spaces that I haven't really played yet, and, there's experts in each one of those fields. Right. And I find it, sometimes it could be very humbling, and you go, wow, crud, I feel like I got this thing going. I know what I'm doing. And then you have a conversation. You're like, okay, it's a different game here,
Yeah.
But at the same time, though, I think that's a growth as an entrepreneur. That's what we're after. So anyway, I'm in that headspace this morning, because of some deals that I'm working on. So, but anyway.
Gotcha.
Anyway.
Yeah, I hear you, man. Did something specifically trigger it, or is it just the general climate that you're hovering in?
No, something specific. I'm working on building a new company, and building it from scratch. So I've done, I don't know, 4 or 5 different business deals at this point in time, and I've never really built one all the way from scratch, right? I mean, I've bought an asset, like I've bought real estate, and I bought an asset and I've worked that asset. I bought a car wash, I bought it and I worked the asset, but somebody built it, right? Somebody built that wash, somebody built that house, that apartment, whatever that may be. This is straight from the ground up. I purchased an existing business. That's nothing to say about the number of businesses that I've put bids in on and have not purchased, And I tell you, there's just as much to learn from those as there is from the ones that you get. And this one is ground up. I mean, we start from the bottom with nothing, and how do you fund it? How do you create value to your clients? How do you recruit? How do you set up your business structure so that it makes sense for each party that's getting into it? This is kind of my first run at this. So, yeah. So I'm really excited. I'm really excited about the future. But you gotta, I don't know, man. When it comes to entrepreneurial work, I mean, a lot of days you just go, crud, man, I didn't kill it today, you know, and, but you could just keep working. You just keep working. You just keep pushing, and, some days you're like, oh, that was a great day. And not only was that the great day, but I really felt like those last 10, 15 days or weeks or whatever led up to this here. And so, you got to have a really strong belief in yourself and what you're doing, because you're going to have challenging days along the way. So anyway.
Yeah, the startup approach versus an existing business or acquisition of an existing business is totally night and day difference. And
it really is.
The startup journey, you quickly realize just the business infrastructure requirements that are hidden that not people realize. How do you start your marketing? How do you build brand identity and then recognition? Your cost of customer acquisition is so much higher because if you're acquiring an existing business, you've already got probably an existing customer base. You've got established ad spend, media, and that stuff that you can simply tweak. I don't say simply, lightly, but you can tweak it. You can modify what's already there. And the hidden aspect of that is that all of that sweat equity has already been baked in and kind of burnt out, and you already have something to work with. The clay model is there, and the clay's still wet, but it's modeled. And in the startup approach, what I've discovered very rapidly in my consultancy is just that. I spent a lot of time getting the LLC in order, the banking, some of that background stuff, some of the administrative tool. But then you have to actually go sell it. And how do you generate those leads? And you start asking questions of, have I identified the right demographic? And you quickly realize, I think oftentimes, that the market dictates to you what that demographic should be. And oftentimes it's different than what perhaps you had imagined beginning.
Right. Yeah.
That's been one of the pivots I've had to take in the consultant, because at first my approach was, oh, well, I'm going to help startups. I can give them all of this advice and stuff, and they can pay me for this advice. But when I had to tap the brakes a bit, because startups don't have money. They don't have this discretionary spend. And also, there's something to be said about that person willing to take the startup leap. They kind of want to learn it on their own, and they don't want to outlay a bunch of cash up front for someone else to tell them some very fundamental 101 Googleable kind of information. So
yeah.
I had to really take a hard left turn and do some deep research into actually who am I trying to target, and actually what is the value proposition that I can offer.
Right.
And it's been an interesting trip.
Yeah, I can imagine. No, you're right. And I think as it relates to, go back to the early part of that, what you were talking about in regards to just business, and whether it be a startup or an existing business, I think that, whenever you decide to get into this space as an individual, whether you decide to buy a business or start one up. My experience has taught me that you're going to be well served going into an area that you're already familiar with. And the reason why is because no matter how many, you know, marketing techniques you have, or how good your LLC or how good your financial setup is, or whatever that may be, your technology, at the end of the day, you still have to service your client. And most of these businesses that we're talking about are service based, right? So you're buying a business, a lot of them are service based. If there's a product based business, then you look at it a little differently. Um, product based businesses, I love those. I love those businesses because the customer that's purchasing that product is not just buying your service, right? They're also buying the product. The second business that I purchased in the car wash is kind of similar to that, right? It's a product based business. So people are coming to the car wash because they need to wash their car. So if I'm keeping that car wash clean, if I'm keeping the equipment up and running, then hey, they're going to keep coming. And in some cases, I don't even have to talk to the customers. Now, when I go by, I'm always saying, hey, how you doing? How's your day going? Stuff like that, right? But I don't have to if I don't want to, because they're there for the car wash. As related to a service business, if you choose to go down a path to buy a service business, and overwhelmingly the number of businesses out there to purchase are service-based businesses. I mean, it's I don't know what the percentage is, but it's an overwhelming amount. And I looked for a service-based business for a full year, and I had certain criteria that I wanted that service business to meet in order to be able to look at it. And it was an under $2 million purchase. That was my goal for the business itself. And I ended up spending a little bit more than that, but that was the goal. That was the set. And when you're doing that, a lot of times in those businesses, they've got the shell, as you mentioned, but they're still missing a whole lot of stuff, and if you don't buy those businesses correctly, if you don't create if you don't mitigate some of the risk factors in that business so that you can have enough capital to do the things that you see that need to be done, that's one of the big keys there. There's lots of keys, there's people, there's execution, there's all, and I'm rambling a little bit, but whenever you get into buying an existing business, right, you really just have to be careful and make sure that, number one, can they deliver well? What is that service delivery mechanism? Who's doing that? Who's responsible for it? And then two, how many different customers do they have, right? I mean, if they tell you they've got 10 or 20 or 30 different customers, well, you need to make sure and understand how they actually come in. Is that through a marketing program? Is that through a sales program? Is it through a third party that delivers that to them that's bundled up? So there's 10 of them bundled up in a third party. So if I lose the one third party, I actually lose 10 customers. So you really need to do research and understand that. And also, anything under 2 million, the majority of the time, if not 100% of the time, the owner is an owner operator. So if you want to buy a business that's under $2 million, and even ones that are just north of that, you need to be prepared to get in there and roll up your sleeves and get dirty. And it's not going to be a hands-off thing. Any business that's hands-off is going to sell at 4, 5, 6 times a multiple, right? Because I can go in, I can invest. I've already got management in place. I've already got sales in place, right? And then if you flip that, right, and you were to say, okay, that right there is actually the blueprint to best sell my business, right? I've got a great service company. I'm going to go buy this great service company. I'm going to work hard, and they're lacking these key ingredients, right? They don't have a good process in place. They're missing a really key technology that can help them, right? Their books are a little messy, and that's not a knock on a young or an old business owner, right? I mean, if you're out there just doing it, right? You look at your bank statement, you see what your cash flow is, right? They don't need to have ideal and perfect P&L statements, right? They do when they sell, but they don't need to have them there in the middle of them doing their business. So you all of a sudden you clean up the P&L statements and the balance sheets, and you implement technology, and you get in there and work your butt off, and you find some good people, create a good sales funnel. Now all of a sudden you get 2, 3, 4 years of that performance, Now, whatever multiple you bought it at, 2.5 times, 2.8 times, something like that, you're going to get 4 or 5 times, because someone's going to be able to come in and go, oh, wow, okay. Yeah, that's a business that actually I can come in, I can invest in, and I don't necessarily have to be there on a daily basis. Everybody that invests wants that dream. That's what they want, right? They want to put their money in, and then they don't want to have to do anything. And I say that in a general sense, because I think we'd all love to invest our money in a business, it create a return, and us not to have to do the daily grind of the business. But anything less than 2 million, you better strap it on, because it's part of the gig. Unless you buy a really heavy product-based business, and even then, if you don't know and understand your business, you're going to get yourself into a big bind. So,
Well, and I can't imagine, just knowing my own personality, handing over my hard-earned money to purchase this business and then expecting that I can just turn my back and walk away and be some silent partner and expect mailbox money. I would go absolutely nuts with that kind of expectation.
But it's not just that, though. It's not just that version, right? I mean, that's the highest level of someone expecting, an investment income type thing. What it is it's you buy it and you think, okay, I only have to be here 2 days a week, right? And it's not that you don't show up; you show up, right? But you're not fully engaged, right? You bought something. Goes back to what I said earlier. When you buy a business, you better be ready to strap in and do the work, which means you also need to at least understand that business a little bit if you can. If at all possible, getting into an area that you have already been in is super helpful, at least for your first one, and very much for your first one, I would say. After that, you start to learn and understand people. You start to figure out how to maybe potentially buy businesses and put people in. But for your very first one, when you're just getting started, you should try to stay in the field that you're in. And that way you can understand the execution piece and the customer piece. And what happens, though, a lot of people is they'll buy that business and they'll go, all right, I only have to spend 2 or 3 days here. And then the morale of the team just goes down, right? Because the previous owner, even if they had been spending that amount of time, what they're not telling you is that they've been there for 20 years and everybody in the office knows them. And, hey, I know Heath, and, he's been around forever and he doesn't need to come into the office. And we like it better when he's not in the office, right? But now you got a new guy or a new gal, and, you've got to build rapport with that team. You got to show up for that team. You've got to be a leader for that team, right? And it's not done in a day, in a month, in 6 months, in a year. It's done over the course of, 18, 24 months, right? I mean, you have to build that rapport with your team. And there's lots that goes into it, but that is one of the keys, is that when you buy that business, get in and be that leader that business needs to be. And if you don't do that, you could go sideways for a while. And that's not why you bought it, right? You bought it because you saw an opportunity to go forward, right? I mean, if I'm paying some sort of multiple, not only do I want a return on my money, but I also want an opportunity to grow that thing, which goes back to how you buy it, right? If I buy it with every piece of capital that I have and everything, and I buy the line that the customer says, oh, look at all these things you can do to grow it, right? And you don't account for that in your price, right? Then you're going to put yourself into a situation where you go sideways for a long time. And that's almost just as bad as going out of business. Believe me, I've felt it. You go sideways for a while and you're like, oh man, I'm trapped. How do I get out of this thing? And what I mean by get out of this is, do I get out of it? Well, that's not the kind of person I am. I just put my head down and go back to work, and but it takes a lot of work, so I'm trying not to, I don't want to sound too down here, but I'm just trying to say, look, when you're going to buy a business, when it's your first business, go in and buy something that get into an area that look for ways that a business that doesn't have or hasn't implemented technology, look for areas where you can see improvements, but it's close. It's improvements that are really close to to the business, right? So technology is one, maybe training management is another, so on and so forth, right?
Well, you're
You
not
can do
sounding
those things.
down. You're not sounding down so much as you're being very responsible in the information. And I say that because uh, early in the journey, I looked at a dry cleaners business,
Okay.
and uh, my uncle had owned his own chain of dry cleaners back in the 80s and 90s. And so I called him up and I said, I'm looking at this dry cleaning business. It's got one central plant, it's got two satellite branches, it's in a growing part of Houston. It
Right.
looks pretty good. The money looks good, maybe a little sketchy in terms of he's been hiding some cash, but still the SDE is solid enough to where I think I can get a loan on this. I think I can cash flow it, get the books a little bit above board. It's got 20 employees, et cetera. There's an empty room in this building. We can grow and la da di da. And my uncle's first question to me was, Richard, do you manage a household budget? I said, yeah. He said, how much of that household budget do you allocate to dry cleaning? It took me a second. I said, well, zero.
Yeah.
He said, there's a reason I exited in the 90s. And then he took me on this journey of the textile industry and how polyesters came in to fad, and polyester is a type of textile that needed this certain care and didn't require this other certain care, and really it caused a downslide of cottons and wools, which you really need as in the dry cleaning industry is part of the core
Right.
value offering. And at the end of the conversation, he told me, I'm not trying to sound negative, but I want you to be informed. And he was spot on. And it scared the shit out of me because I quickly realized that I didn't understand the space. I don't know the textile game. And you have to know that owning a dry
Yeah.
cleaner. And uh, I didn't understand that working in the dry cleaners as an active owner operator, you have to get your hands dirty. It's more managing a ton of employees who work in an extremely hot and humid environment. So there's a matter of safety management. There's a matter of keeping that cultural or that culture in place.
Right.
Something that you talked about, because you're in kind of a hostile environment just by the nature of the business itself. You can't transition into this as a new owner, go hands off and hope that this thing stays glued together without your
Right.
guidance and your leadership and your optimism.
Very true. Very true. I mean, there's so many great things about starting your entrepreneurial journey. And let me be kind of clear here. It's one thing to be an entrepreneur. It's another to be someone that is ready to break free from their corporate 9 to 5 and go buy a business and run that business, grow that business, and have that business be, the business that takes them to the end of the retirement, right? An entrepreneur is someone that's always looking for a different deal to a certain extent, right? Trying to build a business, grow it, and then either sell it, hold on to it, and then go to the next thing. Not everybody is like that. It takes a particular mindset to want to do that. There's a lot of people out there that just say, "Look, I don't want to work for someone else. I'd like to work for myself. So I'm going to go out and buy a business, work that business." And those are great opportunities. If you get into that situation and you've never bought a business before, you need to make sure that you do the very best that you can to communicate with people that have either done that before or reaching out to people that you know to help you along the way. And I have this kind of thought process that You know, when you go buy a business, and I'm speaking from experience here, when you go buy a business, you know, your family's going to be encouraging. You know, they're going to say, "We believe in you." You know, your accountant is going to say, "You should never pay that much for that business. You should just never do it." You know, your attorney is going to put together all the reasons why you must, or not all the reasons why, but all the things you must consider that could potentially go wrong, that could potentially leave you, you know, broke, right? Because you're not gonna get away with buying a business and not have to put some sort of personal guarantee in there. So now there are ways to buy businesses with no money down. And actually, I've done it a couple of times. I bought a couple of properties with no money down. Actually, bought a car wash with no money down, no money out of my pocket at all whatsoever. But we shouldn't go around talking about those being the norm, because they're not. Those are very, very hard to find, and they usually come from a pre-existing situation that you have, right? It's very hard to build into a no money down whenever you're talking to a stranger. Um, and so anyway, back to the point, you know, again, family's going to be supportive. Accountant's going to say you should never pay that much, right? And an attorney's going to say, and they're going to give you all the reasons that have potential high risk for you and your personal guarantee. And even if you reach out to your friends and say, "Hey, what do you think?" Right? They're only going to be supportive. Very few people are going to really dive in and help you do an evaluation, right? Once you ask someone to do more than just have a conversation, you start to find out, I'm kind of on my own here, you know? And when it comes to signing, you know, at the bottom line, you really realize that. You're like, you know, I'm here. The bank, that's another one. The bank, I'm sorry, I forgot to mention that. You're going to get a loan from the bank, right? If your credit is good and the cash flows meet the debt requirement, right? The bank's going to loan you the money, right? They're going to loan you the money. And most of the time you might go through an SBA. That's guaranteed. They don't, that's not like they want it to fail, but at the same time, though, if you got good credit, the cash flow of the business covers the debt service, then the bank will loan you the money. They're not going to dive into that and go, "Hey, have you thought about this? What about marketing? You know, what about," they're not going to do that, right? You're really the broker that's on the other side. That broker is not interested in whether or not what you succeed on the backside of this sale, right? He wants the best sale for it. So it's really a lonely venture out there when you're buying your first business. When I bought my first one, I had a consultant, but I consulted with someone from the industry. So he was telling me all these positive things about the industry itself, and I was getting into an industry that I didn't know. And so I thought that was a great thing to do. It's like, "Hey, I'm going to get into an industry I don't know. Let me talk to someone that's in the industry." And I still think that was a good idea, but I never consulted with someone that knew how to buy a business. And for that, even with all of my education and all the valuation time, and I have evaluated no less than 300 businesses, no less than 300 businesses. And still to this day, the one that I bought was, I believe, the best evaluation that I had in those 300 by far. And there were some things that we did in the purchase that was just really, really valuable and have helped me along the way today. But I didn't consult with anybody that had ever purchased a business before, right? And I just consulted with someone in the industry. So they gave me some good stuff about the industry, but then I didn't have that person kind of telling me, "Okay, these are the things that you need to watch out for. Let's take a look at this evaluation. Let me tell you some of the positives, and let me give you some of the potential challenges that you might face. Here's how you might mitigate those risks. Here's some things that you're not going to be able to mitigate until you get in the door on day one. And here's some things that should be non-negotiable." And so I had to burst through that, you know, by myself. And you really don't want to do that when you're buying your first business. I'm going to tell you right now, like, you know, you may get to the end of a purchase and it may cost you $5,000 to not do the deal. And when you're looking for a business, that sounds like and feels like a lot of money, you know, or maybe it's 10, maybe the option fee is 10, you know, and you're like, "Oh man, I don't feel good about this anymore, but I'm the bank is approved. I'm signing on Tuesday. I've gone all this way." Right. And Money, it's easy to sit here and talk about this right now. There you go. It's easy to sit here and talk about this right now, but when you're in it and you feel that and you've invested so much time and energy into that business, and then something pops up and makes you wonder, right? You would be surprised how hard it is to turn back at that point. It's really hard because you're so locked in. You're so locked in. And that's why, having someone to be able to bounce that idea off at that time is really good, because they can say, look, hey, this is a challenge I think you can overcome. Or you're right, this is a non-starter, you know. Um, so didn't have that, worked through that, felt really good about all of my evaluations, and you know what, at the end of the day, you're always going to make some mistakes. So just understand that when you buy that first business, it's not going to go exactly the way you thought it was, right? So, mistakes are inevitable. You could push through them and turn it into a fantastic thing. But 7 years later, 10 years later, for me, I look back and I go, hey, those were mistakes, but gosh, how much have I grown as an individual, as a business owner, as an entrepreneur over the last 7 years? I go, well, quite a bit, you know, quite a bit. And so I really wouldn't take that back, for anything. So mistakes are part of the process, but having someone to be able to bounce those ideas off could be very helpful.
Are those what are known as the due diligence experts?
Uh, you know, I think there's a lot of people out there that focus on consulting as a primary gig. What I'm more interested in is I'm more interested in finding people that I can have conversations with, but also are out there doing it. Because remember what I said right when I first started, there's levels to this thing, right? There's levels. And, anything less than, say, $10 million on a purchase, I feel really good about. I feel really, really good, you know. But you get outside of that and you start to change the structure a little bit. I go, okay, these are some things that I don't know, you know. And well, how do you learn them? Well, you get engaged with others, and you be a part of different groups and things. But you have to start in one place or one space. So I'm always searching and finding consultants, including myself, that are actively doing right. And Yeah, I just think that's the best way, because we're always learning. I mean, we are never not learning, and there's a level of expertise that I have that's, 10 million and below. Right. And I feel really good about that. But at the same time, though, I'm still learning, right? I'm still figuring that thing out. Like, how do you aggressively grow a $2 million company to get it to $5 million, And I'm going to tell you right now, you sit across from the table from another company and you say, hey, so when you were at 2 million, how did you get to 5? Right. And you'd be surprised how few people can really describe how they made that jump. And I believe one of the reasons why that is, kind of shifting into a slightly different subject here, is because there is no magic paste. There's not a magic, it's just not magic. It's just one day waking up, going out, getting the work done, servicing your client, and then the next day going and doing this exact same thing. And the more that you do that, what you're going to find is that one day one of those clients turns into a multi-client, right? And then that multi-client turns into a huge client. And then all of a sudden, you take one customer and then you're adding $2 million in business because that customer introduced you to someone that brings you a whole book of business. But you don't get that if you don't take good care of the customer. You don't get that if you don't show up every day. You just don't get it, right? If you wake up every day going, how do I get that customer? That's not even the right attitude. The right attitude is wake up and go service your client, and have some general business sense around marketing and growth and things like that. You have to do that. Of course, you have to do those things. I mean, there's a playbook. I would say, yes, of course there is a playbook, but I would say that every business has a different playbook, to a certain extent. And so, that you ask a company, hey, how did you get from 2 to 5 or 5 to 10, and they a lot of times they really struggle to be able to tell you. And I've asked a ton of them. And as I'm trying to, build that up, from 1 to 5 to 8 to 10, as I'm like, hey, how do you get to 8 million? How did you do that? The answers are underwhelming. They're underwhelming. Everybody's looking for the secret sauce, but the answers are very underwhelming. They're just, I service my client, and then this client introduced me to this client, right? I didn't even know it. I didn't even know that Richard had this particular customer, and he introduced me because I'd been servicing him for the last year and taking care of his business. And he was like, "Hey, you should talk to this guy." And, they've got 10 apartments underneath them, and boom, all of a sudden I did $2 million. You know, and but you don't get there if you don't service your client.
On your first acquisition, what was the type of business, and how did you get it funded?
First acquisition was we'll talk about buying a business, right? Not necessarily about real estate. So my first acquisition as it relates to buying a particular business, I bought a fire and water restoration business. And I funded it through the SBA, and that went fine. I also used a 401k, converted into a C corp, and used some funds from my retirement income to do that. So I didn't take any of my usable cash out of my account to do it. I used my 401k to do it, or a portion of it, and all of that was fine. It is that using your 401k and turning that into a C corp. I will say, as you get into that, you start to realize the challenges, the double taxation with the C corp, being able to pay it back. You actually have to have that money has to be double taxed in order for you to be able to send it back to the 401k. So it can be a real big challenge. Also, your flexibility with the C corp is really challenging. You have annual filings that need to be done that are much more inclusive, several additional costs associated with a business evaluation every year. Not only that, but it's just, you just really don't have a lot of flexibility with the C corp. However, if it's your only option and you feel really good about the business, it certainly is an option. And funded it through the SBA, and built a relationship with the bank. They didn't know me to start, and they funded it, and we just went and did it. And but that goes what I was saying earlier. I was 6 months into this evaluation, right? I'd evaluated it. I had several meetings with the owner, trying to negotiate what I thought was the best deal. Along the way, trying to learn the industry through a third party consultant. It was quite the ordeal. And of course, this was after an evaluation, like I said earlier, of no less than 300 businesses. No less. And this one, by far, it included real estate in the deal. It had an office. Most of the businesses under $2 million, they were run out of their garage or some, small, one door facility, right? And he met all three of my criteria. And so I really found myself going, okay, how do I make this work? I really went into the deal going, I'm going to find a way to make this work. Right. And that's a good attitude to have. But at the same time, it's also, sometimes that can be detrimental to your psyche. Right. Because when you run across that thing that you go, hey, this is a non-negotiable factor here, you might end up making a bad decision, or not really a bad decision, but just a decision that you have to overcome later.
You're like
right?
Talking yourself into a tough spot.
Yeah, you're already in. It's really difficult when you're just like, I'm already in. I'm 6 months in. I'm in this thing. And then you come across something and you go, oh man, that doesn't seem right. Should I go back and renegotiate? What should I do about this? And then you look at your contract and you go, well, gosh, I'm already past the option period. It looks like I could lose $8,000 here if I, you talk to your attorney, and he's like, well, and so you go, well, when you don't have a business and you're looking at $8,000 of a loss, you're going, man, that's a lot of money to lose on a deal that I've been working 4 or 5 months. And you can see how you get so vested in something that it makes it very, very difficult if you run across a a non-negotiable, and you don't know what to do, but you're already, you're half buried at that point.
And on the 401k play, that's how we're venturing out on our first one. We haven't closed the deal yet, but we have the C Corp set up, and you and I have talked before about the deeper understanding that's not quite sold to you at the outset of this by those companies that are really invested in selling this. And one of those constraints, I suppose, is that you can't just move money to the bottom line and put that in your bank account and you're walking with the net income. It's a different approach. You have fiduciary responsibility to the business, and you can only pull out what is deemed as a reasonable salary for someone in that position of that industry.
That's exactly right. And you are a fiduciary, not for the business first, but for the 401k. And one of the things that you need to make sure that whenever someone goes into this thing, the way it's structured is your 401k is purchasing the business. Now you'll have to put a little money in, so you might end up with 5 or 10% of the business as an individual, but the 401k is purchasing the business, just like on a stock exchange where the corporation owns 90% of the stock. And so as the value of that company increases, the value of that stock increases. And so if you ever wanted to, this is the thing, one of the very first things that got me on this 401k thing. Let's just use $500,000 as an example. Okay. I put $500,000 in my 401k and I purchase a $2.5 million business, right? And the valuation of that business at the time is $2.5 million. And that got me $500,000 worth of C Corp investment. Every year I have to do a business eval. Okay. If my business evaluation goes up, if my net goes up, right? So it's 2.5 minus the 2 million in debt. So I've got a $500,000 worth of net. If the next year my valuation goes up, my revenues grew, whatever happened to the business, I paid off some debt. I say I had a great year. Now the business eval is up to 800,000, right? A lot of people think I just pay back that $500,000, turn my C Corp into an S Corp, and then I can filter and do things the way I want to do as it relates to accounting, I guess you might call it, right? Taxing and accounting. But you can't, because now the C Corp wants 800,000. They want 90% of 800,000. They want 720,000. So now your 500 is now 720. The only way you can pay your C Corp back is through earnings. You have to pay it back. Okay, this is a big key. You have to pay it back. You can't use funds inside the business to pay it back, right? You have to pay it back. So that means that you have to provide yourself with earnings and use that money to pay it back. And so you're paying a little bit, say you pay $50,000, $60,000, $70,000, right? Out of your earnings that's been taxed, right? And then the next year you grow again, And so now instead of 720, now it's, you paid off 70,000. Now you only at 650 to clear it, but then you grow and now the valuation's $1 million, right? So that 650 pops up another 200, to 150,000. So now it's back up to 800. So it feels like a push, pull, and you just go, man, I don't think I can ever do it. And then at some point you just go, okay, that's it. This is going to be, I'm going to receive a W-2 salary. The person that puts you in reminds you that every dollar that you make, don't worry too much about it, because it is your money, right? So it is going back into the 401k. So if you find yourself in your late 40s, early 50s, you can start pulling money out of your 401k when you're 55 without, getting penalized. So, if you find yourself, 46, 47, 48 years old, and I'm going to work the next 7, 8, 10 years, and then I'm going to sell the business, and then I'm going to take that and I'm going to it's going to go right back into your 401k, So that, as an entrepreneur, if you're that person that I mentioned earlier, the guy that wants to buy the business and work it, right? Guy or gal, And that's really actually not a bad gig, right? Work it, let it go back into your 401k. Hopefully you're 45, 55 by that time. You can start pulling it out. No worries. If you're an entrepreneur and you want to take that money and go and reinvest in another business, you got a big challenge ahead of yourself, right? Because you're not cash rich, right? Your 401k is doing well, but you're not as a individual investor, you're not cash rich, right? So that's where the challenge comes in. If you're like me and you're like, okay, this is going good, let's go see what else I can do, right? And right now I'm on my fourth business. I mean, four businesses operating right now. And I'm always going, okay, how can I identify this business? How can I grow this business? Who can I put in charge of this business, incentivize in the right way, build the right processes, implement the right technologies. And then I'm looking to go do it again, and that's not for everybody. It's just the way that I think. And in that particular case, from a C Corp perspective, I'm in a bind. If I want to take the money from my first business and invest it in another one, it's almost impossible to get it done. And believe me, I've sat down and talked to my guys for hours going, I just don't understand. Why can't I use this money? And he's like,
Right.
well, because it's not yours. You're the fiduciary of your 401k. You have a legal responsibility to your 401k first, not to you, but to your 401k. And I go, well, I'm the same person. They go, no, no, no. You are the fiduciary for your 401k. And
That's
so,
the confusing part. And
yeah.
I was thinking about this yesterday. You're constrained by what the industry deems a reasonable salary for someone being an owner operator of XYZ company here. So let's say it's the car wash, just for round numbers sake, let's say you're the GM of the car wash, that the 401k holding and C Corp holding company has purchased, and now you're managing on behalf of that 401k. But can you reasonably structure in some sort of, call it a bonus payout as GM? Yeah, you get this $100,000 salary, say, but what if you grow the business by 100%? Can you also have in your, say, offer of employment some sort of bonus structure that can pay out a lump sum that you've done your fiduciary responsibility for the business, but now industry recognizes a reasonable bonus structure where you can then take that chunk out. It's now your personal money, and then use that outside of the C Corp to go do another business.
You absolutely can. But what your advisor will tell you is that you need to be able, if the IRS comes back, right, and says, hey, this money should have gone to the corporation, you need to be able to prove that a CEO or a general manager should be able to receive this compensation. It's not your job. It's not their job to prove it. It's your job to prove it. So you have to prove it. Now, with that said, my personal opinion on that is that if you have a great year, you absolutely can pay yourself a bonus. You just can't make it so obvious, like, hey, I made $75,000 that year as a GM, and I paid myself a $200,000 bonus. Well, that's not going to really fly.
Yeah.
But I made $75,000 and I paid myself a $50,000 bonus. Yeah, that's okay. Then my salary went up next year to 100, and I paid myself a 50 to 75,000. Well, that's okay. It's when you start to double up, over and above your salary is when, the IRS could say, hey, I don't think that is in the best interest of your corporation.
And the other nuance that you mentioned is the double taxation in this structure. So what does that look like?
Well, if you want to take out, you can take money out direct through a W-2, right? So you, like, in my first business, I pay myself a salary. And so that comes out first. And that's really kind of the best way to do it, But if you want to pay the 401k back, you can't use it with earnings from the company. And this kind of goes to another challenge, is that whenever you buy your business and you use it with your 401k, one of the things that a good steward is going to do is try to grow an amount of money in your bank account, right? I mean, it doesn't, let's just say, for example, that your operating expenses monthly are $22,000, right? And we all grew up, right? Hey, mom and dad, you need to have 4 months worth of expenses in your bank account, right? So as a business owner, you might be thinking, well, I need $100,000 in the bank, you know? So that's money you don't pay yourself, right? So you put $100,000 in the bank. When at the end of the year, whatever money you pay yourself, you get taxed on, right? That $100,000, if you don't pay it to you, it gets taxed on at a corporate rate. Okay. So let's say it gets taxed at 25%. And just for ease of calculation, let's assume you don't have depreciation or amortization. When you buy a business, you do have both. So you will have some tax benefits for the first number of years. But let's just, for ease of calculation, let's just say that you don't have those in this situation. Corporate rate's right around 25%. So you're going to pay $25,000 of that $100,000 in earnings. And now you've got $75,000 in the bank. If you choose at a later date to take that out, right, you're going to get taxed again, right? So, and because it can't go out, it's already in the business, right? If you choose to pay it to yourself, then you're going to get taxed as an employee, right? You don't, even if you take a dividend, you still have to get taxed on it. So, because the dividend comes out in earnings. So that's where it kind of hits you. And one of the biggest challenges is that when you buy a business with your C Corp, what I said earlier, you want to get to that 4 or 5 times, expenses in your account. And then you're like, okay, well, I'm doing good, but I want to grow my business. And you start to realize that not only when you grow your business, you also need an increase in working capital to grow your business. Now, all of a sudden, it's not 100, it's 300 or 400, and so you're like trying to actively, my goal early on was, I got to get $500,000 in the bank. That's what I want. I want $500,000 in my account, because if we hit a bump, restoration, the first business that I bought, restoration, it's not a cyclical business in regards to throughout the year. It's almost, throughout the course of time, right? It's not like, say, oil and gas, where, things could come down and then you could be sitting there for years, right? But in restoration, there are moments in time throughout the year, like around the holiday season, when there's really not a lot of work going on. And then it kind of ramps up and cycles throughout the year. But any given year, storms happen, no matter what the economy is. That's one of the reasons why I love that business, is because we're always going to have work. But I lost my train of thought there. But on that particular business, that's a good value to have. But as I was trying to grow my income, I wanted to get $500,000 in the bank. That was my goal, because if we had 3 months of a lull, over the holiday season, I wanted to be able to go, look, if I've grown my business to 5, 10, 15 employees, I'm not worried about payroll. I'm not worried about, these things. I can hire the right salespeople so that I can grow my business. And so you end up just putting more in there, because a good steward of his business, trying to grow it, didn't get in that thing to keep it to where it was. Right.
In your restoration business, previously you'd mentioned identifying an opportunity through that business, which it presented a new means for you to expand and purchase a new business. And I think it was a plumbing company or something of that nature.
Yes. Yeah.
Yeah. What was that scenario?
So as I worked through the restoration business, I really identified that one of the strong verticals was plumbing. And so this story is a story of a business that I didn't purchase. And, having the experience in purchasing that first business, working through some of the challenges that we encountered, Whenever I went and I worked to buy this plumbing company, because it was a direct vertical. You have someone that has some sort of leak or problem, they call a plumber first. A lot of times in our line of work, that plumber can call a restoration company. The restoration company can come out and clean it up after the plumber fixes the leak. So I found what I thought was a phenomenal opportunity, and I really worked it hard for 6 months. I mean, I worked it hard. I went out, I had dinner with the owners. I brought my wife in. I wanted them to really get to know me. And I really believe that's the best way to go about buying a business, is to get into a situation where you get vested with those folks and get them to like you and want to get to know you as a person. And we did that. We worked really hard, and I thought we had an opportunity that I felt like was going to be a huge win-win for both of us. But his broker got in the way, in my opinion, and decided that no, they didn't want to help me mitigate some of my risk, right, and be able to get what they wanted. They wanted out, right? They just wanted out. So they wanted me to pay them a lump sum of money. They wanted to stick around for 6 weeks, and they wanted to be out. And I'm like, listen, that's just not going to work. It doesn't work with my risk profile. And I was vested, okay? I mean, I was vested. I mean, I had spent a ton of time with these folks. I liked them, and I was excited about it, but I was able to walk away, because of past experience. And today I feel really good about that. I had another one, a pizza shop that I almost bought. Worked with that group for about 3 months and really evaluated that business, really liked the margins, really saw some tremendous upside, and tried to work with them on, okay, how can I get you what you want, and how can I get what I need in order to have a little bit of capital on the back end to be able to grow this thing the way that you and I suggest. And put an offer out there. The second and third in command loved it, wanted to do it, but the top guy wanted his money, right? He just wanted the dollars right then, and that just told me that he didn't care about my success, right? He wasn't trying to take his brand and build it into something that was valuable. He just wanted the money, and so I knew that wasn't a good deal, but that's kind of the part of being an entrepreneur. I mean, they don't talk about how many deals you have to look at in order to find the deal, so it's a lot. It's a lot of deals. You have to look at a lot of deals to find a good one.
I had one just fall through.
Did you?
A week ago, 2 weeks, week and a half. I was so optimistic about this business, and let's just say it's in outdoor entertainment, travel, leisure, athletics. It's in that kind of space, and it was a 4-acre property. They were only using one of the acres for some lakeside activities for this outdoor destination. And I just had this vision of what to do with the other 3 acres.
Yeah.
In the SIM, or the business summary, they mentioned a funding scenario where there would be a seller's note attached to this. And the seller was willing to put up 45% on this deal, which it's unbelievable.
That's great.
It's very hard to find that. And so I think the numbers roughly worked out to call it a $1.5 million business, and they would finance 900,000 of it. And the lender had already pre-qualified it with this particular schematic of funding. I spoke with that lender. The lender looked at my financials and was able to actually tweak that number to the better of the seller, so that we decreased that $900,000 note that they would carry down to somewhere around 500, 550. And
that's positive.
Out of my pocket, I'd only be putting 5% down on the business. And
Okay.
on top of that, because real estate was more than 51%, according to SBA rule, 51% or more being real estate, you can roll that entire loan into a 25-year note.
Whew.
And so suddenly I was faced with this $1.5 million business, roughly, that I could put minimal money down and I could finance over 25 years, that had 3 empty acres of land that I had a vision for, a multi-phase growth plan. And I started reaching out to industry contacts. Hey, what would you do with this little half acre over here? What would you do over here? It was wonderful. So we presented a better deal than the seller even wanted. And then it went silent. And I submitted an LOI, but then it went silent. And the broker came back several days later and said, would you be able to put even more cash down? Because the seller is looking at the numbers. They want to open another one of these businesses out in California, but they won't have the cash required out of this deal to do that. My response back was absolutely not, because we've already presented a deal that's better than they thought they needed 2 weeks ago. It got a little heated because I felt like I was the one doing the gyrating, but I was offering value. And to your point, suddenly overnight, now the sellers saw zero value in a transition, in having their legacy survive. They just wanted the money and they wanted out. They wanted the quick win without any kind of lingering skin in the game over time. I even promised an accelerated seller's note after 2 years instead of 5, and all of this stuff. But I think one, they didn't do the math. They didn't do their own diligence on what they would actually walk away with under their scenario. And the time value of money was something that they perhaps were underestimating as well.
Yeah.
It turns out it's probably best, because of how that went. It's probably best that this deal did not go through. But anyway, that's my recent legacy. And it was so frustrating because I was so emotionally invested.
You were there. Yeah.
I was there, man.
Yeah. No, that's tough. And did you get a chance to build a relationship with the client? Let me put this thing on charge here. So, you did?
Yeah, minimally. It was minimal. We had a great phone call, and
Okay.
we had another follow-up phone call after that. And I had discussed some very specific talking points of keeping their name on the business to allow the legacy to continue.
Right.
There would be some affiliative sponsorships because they're known in the industry. They're professionals, competitive professionals in that industry. And so I offered a continuing relationship from where we were. And I offered loyalty to their current employees in the form of expanding the business to where it's not so seasonally cyclical, to where these employees could have a full 365-day calendar. They could be placed on a career roadmap to
Right.
better themselves as professionals. They could take advantage of the 401k that I'm using to fund my business, and they would now be able to invest in retirement. And so everything we discussed was exactly what the seller wanted out of that deal. And so we built the rapport in that manner, but I guess it just wasn't enough.
Yeah. Yeah. A lot of challenges there, I think, is, when brokers get involved in businesses, a lot of times in order to be able to get the contract with the customer, they have to present a future. And in a seller's mind, once a broker presents, the concept of the idea of what you're going to walk away with or how this is all going to go down, man, it gets very difficult for them to kind of change that picture in their mind, that mental picture in their mind. And, that's why buying businesses from brokerage houses are one of the most challenging things to do to get a good deal. I mean, if I was buying a business and I knew exactly, the industry I wanted to go into, I wouldn't do it that way at all. There's literally millions of businesses out there right now with owners that are in their 60s and 70s. And there are ways to go in and get that business at a reasonable rate of return. And what you have to give up in return is some of your time. And what you don't realize is that, I'm not saying you, I'm saying in general, is that what you don't realize is that you were going to have to give up your time anyway, and so you can't look at it as a lost thing, right? And, you can't look at it as, well, no, you were going to give up your time anyway. So you go in there and you go sit down with a customer, a business owner that's 67 years old, and he's owned the business for 25 years, and he doesn't have, an exit strategy, hadn't even thought about it, right? You build a rapport with that individual and you say, look, if I grow your business, can I get 50% of everything that I grow? Yeah, absolutely. Okay. Well, I might take you 20 of them to find that one guy, but you build a relationship with that guy. And then after you grow the business, you put stipulations in that contract that say, if I do this, I want to be able to have the opportunity to buy your original portion and keep you on as a 25% owner. Next thing you know, you've just bought a business with zero money down, and all you've put in is just your work, right? Now there's some risk in doing that, but there's risk in any endeavor, and if you want to go out and provide value, which you know what, you're going to have to do that anyway. You can get great deals. That's how I bought my car wash. I bought the car wash from the existing owner because I was borrowing a weed eater, and we were just striking up a conversation. And he was like, "Man, I'm tired. I'm exhausted." And I said, "Oh, okay." I said, "Well, listen, I love the car wash business." He's like, "Yeah, I mean, it's great, but been doing it for 17 years. I need a break." And I said, "Well, if you're ever willing to sell it, I would love to, you know, be the one that buys it." He said, "Really?" I said, "Yeah." So I evaluated that business with him for 3 months, and he ended up giving me a fair price. I was able for him to carry 10% down. I was able to get a small itty bitty loan for the rest of the down payment. And I just did that because I wanted to see if I could do it. I paid back that in the first 6 months, and then I paid him off in the next 6 months. So within a year, my whole investment had been paid back. And all I was left with was the car wash. And then after that, 12 months in, I went to the bank and we refinanced, and we took money out with no tax. So that was a great success. And the great part about that story is really when we went to closing, in my mind, I was like, we need to get here fast before this dude changes his mind. I've been evaluating this thing for 3 months. I know exactly what I'm going to do. I know exactly how to do it. I feel really good about this, and it was an easy close, because it was a win-win for both of us, and that's how it should feel. Really, it really should feel that way because, man, you're buying something that is about to be your life, and so you really should feel really good about it. It's okay to be a little nervous, but it's if you don't feel really good about the opportunity when you get it, then you probably haven't evaluated all the pieces to it.
Yeah, and oftentimes it's not just flipping a house. That's not the mindset. You're purchasing someone's family legacy in some of these deals. There's
Right.
something special about that.
Oh, okay.
Yeah. Well, Heath, we're gonna get on down the dusty trail.
Okay.
What's what does your future look like? What's the startup you're working on?
It's in oil and gas, and it's a space that I've been in for a long time. And so, we're about 75% of the way there, hoping to get kicked off here in the next, I don't know, 8 to 10 weeks. And it's a done deal. We're going to get it done. It's going to be on the move. So um, it's going to be great. I'm really looking forward to it. But also, the fire and water restoration business is still going. The real estate business and the car wash is still going. So those are all good things, and I just find myself loving getting engaged in these business transactions and being a part of it, whether it be from the start or buying existing or whatever that may be. And so I'm just looking forward to it. It's going to be a lot of work, but there's no way to skim around that, whatever you decide to do in the business world, you got to strap on the feed bag and get ready because it's going to be work.
Excellent. So how about we check back in with you after you kick this thing off in 8 to 10 weeks or whatnot?
Yeah, sounds good. I'd love to give you an update on how it's going. I mean, there would be lots to talk about.
Beautiful. Well, good luck, man.
All right. Thanks for having me.
This episode is brought to you by Crash Test Designs, a company dedicated to teaching teams and organizations to embrace change through the application of human-centered design principles and agile project management frameworks. Crash Test Designs are registered Scrum trainers that offer world-class agile project management training designed to create practicing Scrum masters and product owners. Through their instruction, students are prepared to lead Scrum teams immediately. Use the coupon code BLUESKY at checkout for 10% off your next training. For course dates and information on additional offerings, visit www.crashtestdesigns.com. This episode of Blue Sky is sponsored by The Vanguard, the definitive online community for defense and aerospace leaders and innovators to grow, communicate, and build capacity in our defense industrial base. With curated discussion forums, exclusive networking, a desktop and mobile app, and unique access to working sessions and AMAs with top leaders in the defense and aerospace industries, The Vanguard is the next generation career accelerator for those looking to break into or make an impact on the defense and aerospace sectors. Join the ranks of The Vanguard today with a free trial and enter coupon code Blue Sky, that's one word, Blue Sky, at the link in this posting. This episode of Blue Sky is sponsored by Parabolic. Parabolic is dedicated to growing wealth together through business and organizational development services designed by conducting a rigorous workshop with your business leaders. Are you a small to medium-sized business needing to grow into new markets? Or have you grown too rapidly and now need to unwind some of the damage? There is no cookie-cutter template to solve your unique issues. There is no step-by-step proprietary method these other consultants claim for high fees. Parabolic focuses specifically on your unique challenges in a one-on-one setting to dive deeply into the issues, to develop a list of action items and next steps, and if we can help with those steps, we'll talk about it. No strings, no BS. Visit parabolic-strategy.com today to contact us. parabolic-strategy.com. Let's go vertical.